You put $500 into your first investment account. You watch the number. It goes up $23. Then you feel something. But then it drops $41. And now you're sitting there wondering if you just made a mistake. Not, maybe I should have picked something different. Actually wondering whether this whole thing is a sophisticated way for other people to take your money. That feeling isn't a sign that you're bad with money. It's a sign that your brain is doing something very specific. And once you understand what it is, investing stops feeling like a game you don't know the rules to. Here's what's actually happening. Your brain doesn't have a mental model for investing, so it borrows the closest one it has. And for most people who've never invested before, the closest match for, I gave someone money and now I'm waiting to see what happens, is some version of a bet. That's it. That's the whole mechanism. It's not about knowledge. It's not about discipline. It's about which mental category your brain defaults to when it's trying to make sense of something new. And once it files investing under gambling, everything you feel about your portfolio gets filtered through that lens. Every drop feels like losing. Every gain feels like luck. And the whole thing starts to feel like something you probably shouldn't be doing. Now here's why that matters more than most people realize. Gambling and investing share a surface structure that looks almost identical. You put money in, something happens you didn't control. A number goes up or down, and you feel something based on that number. Your brain is incredibly efficient at pattern matching. When it encounters something new, it doesn't build a new category from scratch. It scans for the closest thing it already knows and files the new experience there. For most people, I put money somewhere and I'm waiting to see what happens, lands directly in the gambling folder. And the brain does this automatically, before you've even had a chance to think about it. The problem isn't that your brain is wrong to make the comparison. The problem is that the surface looks the same, but the underlying reality is completely different. In gambling, you own nothing. You placed a bet. When the outcome is decided, the money is either gone or it comes back multiplied. There's no asset underneath it. There's nothing real you're holding. In investing, actual investing, not trading, not speculation, you own something. A fraction of a real business, a piece of real estate, a loan to a government or a company. Something real is underneath the number. The number isn't the investment. The number is just what other people currently think your piece of that real thing is worth. And other people's opinions shift constantly, with the news cycle, with fear, with optimism, with events that have nothing to do with the underlying thing you own. That's a completely different situation. But it doesn't feel like one until your brain has enough experience to build a new mental category for it. But here's where it gets more interesting, because understanding this intellectually doesn't actually fix the feeling. And almost every piece of conventional investing advice completely misses why. Just be patient. Don't look at it every day. Stay the course. These aren't wrong, but they're behavioral instructions. They tell you what to do, and say nothing about what to do with what you're feeling. And when your brain is quietly running the gambling model in the background, just be patient sounds exactly like what a problem gambler tells themselves at 2 a.m. Keep your chips on the table and try not to think about it. The advice isn't the issue. What's missing is the thing the advice assumes you already have. A mental model that makes the behavior make sense. Without that, you're not being patient. You're just tolerating anxiety. What actually needs to shift isn't your behavior. It's the framework your brain is using to interpret what it's seeing. And that doesn't happen from reading about compound interest or watching market history videos. It happens when your brain accumulates enough real, lived experience with markets to build a new category. One where volatility is normal, where drops are expected, where the underlying asset still exists when the number goes down. And here's the part of this that most people have never heard. The emotional volatility you feel as a new investor, the anxiety, the second guessing, the checking the app way more than you should, isn't a sign that you lack discipline. It's a completely rational response to a situation where you have zero personal reference points. Think about what's actually happening when your portfolio drops 8% for the first time. You don't have a memory of watching it drop 8% before and then recover. You haven't lived through a correction in your own account. You have exactly 0 data points from your own experience telling you this is temporary. So your brain, doing exactly what it was built to do, treats it as a real threat. Because for all your nervous system knows, this is the time it doesn't come back. The experienced investor who shrugs off a 15% drop isn't calmer because they have more discipline or a stronger stomach. They're calmer because they have more data. Their nervous system has been through drops before and came out the other side. They have that in their body, not just their head. That's not willpower. That's just information that their experience gave them, and that you don't have yet. Which means the standard advice, don't check your portfolio every day, actually has it slightly backwards. The problem isn't that you're looking too often. The problem is that every time you look, you don't know how to read what you're seeing. You're reading a language your nervous system hasn't learned yet. And here's where this gets personal. Because there's a version of this feeling that most people won't say out loud. It's not just, this feels like gambling. It's something quieter than that. It's, maybe I'm not the kind of person who understands money. That belief shows up in a very specific pattern. People who feel this way tend to delay starting. Not consciously. They tell themselves they'll invest once they understand it better, once they've done more research, once they feel more ready. Which is how, I'm going to start investing this year, becomes a sentence someone has been saying to themselves for 6 years without ever opening an account. And the painful part is that the delay has a cost that doesn't care about the reason. Every year you're not invested is a year your money isn't compounding. The math doesn't factor in that you were being careful. It just starts from when you started. But the delay makes complete sense when you understand what's really driving it. Investing feels like the kind of thing where you can find out you're bad at it. And nobody wants to discover they're not good at something that matters this much. Waiting feels less like avoidance and more like preparation. It feels responsible. But it's actually the anxiety in a more socially acceptable outfit. Here's what I want you to sit with. The investors who feel most confident aren't confident because they figured everything out before they started. They're confident because they've been wrong, watched the recovery, and let their understanding update. The confidence came from experience, not the other way around. You cannot read your way into the felt sense that market drops are temporary. You cannot think your way into it. It gets encoded in the body by living through it. The first time your portfolio drops and comes back, something actually shifts, not just intellectually. Your nervous system learns something that no amount of research can teach it. And the second time, it's a little easier. And the third time, you've started building the model. So what do you actually do with this? First, stop reading your portfolio like a scoreboard and start reading it like an ownership ledger. It's not a score. It's a list of things you partially own. Real businesses, real assets. The number underneath each one is what someone would pay you for your piece today. That number will move. The thing underneath it doesn't disappear when the number goes down. Second, accept that your nervous system is going to misread this for a while. That's not a character flaw. It's not a sign that you're doing it wrong. It's just how the brain works when it's building a new mental model. You cannot force your way through it. You have to earn it with time and experience. Third, make your first investment small enough that the anxiety is manageable, but real enough that you actually feel it move. Too small, and your brain learns nothing because the stakes don't register. Too large, and the anxiety is so loud it drowns out any useful signal. You need enough skin in the game that the experience is real, because the experience is literally what you're trying to collect. The money isn't the point yet. The data is. The reason investing feels like gambling at the beginning isn't because you're confused or uneducated. It's because your brain genuinely hasn't finished building the mental model it needs. And it can't finish from information alone. It needs experience. Real, lived, felt experience, with your own money moving and your own reaction to watching it move. You're not bad with money. You're just at the beginning of something your nervous system has never done before. That's not a problem. That's just the starting line. If you've had the moment, the one where you checked your account and your stomach dropped, and for a second you genuinely thought, "What did I do?" Drop it in the comments. Because I think a lot of people have been there and assumed they were the only one. And sometimes the most useful thing is just knowing that's actually the normal first chapter.